45 years, 0 name changes, new offices, more staff, improved technology to better serve you. Education, services, investments. Think real estate, think Marshall Reddick. Brokerage, property management, private lending, creating financial independence through real estate since 1979.
Okay. Thanks everybody for joining us again tonight. Some new people just joined on here. For those of you who did not hear before, my name is Cameron Carlson, and I'll be presenting alongside Erin Crowley. We're excited to talk to you about this topic here on 1031 exchanges, how to sell without paying taxes. Okay. Erin, if you want to just move the next slide right there.
Yep, sorry.
Perfect. So a little about me. I'm a licensed real estate agent here in Orange County. I got my bachelor's from Vanguard University. I have my primary residence here. Excited to expand my real estate portfolio out of state as well. I'm happily married. My sweet wife Faith is in the top right corner, and then our little baby Cammie Lee with the cutest little smile right there. That's our 2-month-old baby girl at home. So I'm going through it. For those of you who know what it's like with having no sleep, that's what I'm at right now. But it's honestly, it's such a blessing. And then I've done real estate transactions in 7 different states. I invest in the Marshall Reddick Mortgage Fund. I helped about 100 landlords find property management in the last year. So for owners that are curious about what Marshall Reddick management looks like, or wanting to switch over management companies, or just rent your home out for the first time, that's really the other side of what I do. Is I like to talk to you about that. I've done 31 sales in the last 12 months, and that's a little bit about me. Okay. So some topics we're going to cover today. We're going to talk about what capital gains taxes are. What are the benefits of a 1031 exchange? And what are some basic requirements to know? What is like-kind property? What is the exchange equation? And finally, what are the timelines and the rules? I know we probably hear numbers floating around, but it'll be nice to get everything hammered out in detail. And what we expect from you is we want you to learn something. Feel free to take notes, ask as many questions as you can. You can ask questions in the chat here as well, and we'll get those answered at the very end. But if you have any questions that might not be able to be answered quickly, feel free to write them down, and we'll reach out in a follow-up consultation. Be ready for different links, and the webinar will be sent within 24 hours, as well as the slide deck. So if you missed something, don't worry, you guys will have the ability to go back and look at it later. So some of you are familiar with Marshall Reddick, and for others of you, this might be your first time hearing about us. Essentially, we are a full service real estate firm, and we have 4 divisions within the company. The first division is the real estate brokerage. So we help people buy and sell their primary homes, as well as buy and sell investment properties. Nationwide, we did around 600 transactions last year, and 90% of those transactions we also manage for the investment transactions. And that brings us to our second division, which is property management. Essentially, we take care of everything for the landlord, from leasing to maintenance to renovation, rent collections, and much more. Basically, all you need to do is collect a rent check every month. And the third division is private lending. So sometimes when you can't qualify for conventional financing, you'll need private financing. And Marshall Reddick provides non-owner occupied real estate loans to borrowers doing fix and flips, new construction, or just purchasing investment property in general. And then the fourth division is mortgage investing. So the same way that you can own real estate and collect rent checks, our investors own mortgages and collect mortgage payments. I personally invest in the Marshall Reddick Mortgage Fund, where I don't really need to think about it. I just collect quarterly distributions. And if you have questions, we can answer those on a follow-up call. And within all of this, I'm just an advisor here at Marshall Reddick. Okay. So Marshall Reddick's located in 11 metropolitans across the U.S., and you can see them on the map here. We're in Los Angeles, Newport, New Braunfels, San Antonio, Dallas, Austin, Houston, Clarksville, Nashville, and Florida. So California, Texas, Tennessee, and Florida. And next slide here, we'll kind of explain the why. Like, Why these states? Why these markets? Well, as an investor, it's very important which market you choose, and there are several reasons why we selected these ones. We want to look for markets with strong economic growth, low unemployment rate, a stable jobs market. We also want a market where there is a high rental demand. These markets are very landlord friendly. They have a good ratio of renters to homeowners. These markets have very diverse economic industry. We like to see a variety of essential industries like military, medical, insurance, communication, and maybe IT. Those are very, very big industries we like to see in the markets we choose. Also, it's important that the market has a low barrier of entry. Are the houses affordable for investors? Maybe the suburbs have more affordable, family-friendly neighborhoods. We want to see good education system. This leads to well-educated tenants and more desirable school districts. Maybe there's a university in the area. Maybe you have a lot of, 7, 8, 9 out of 10 ratings on the, grade school or wherever you're looking for school ratings, and that helps with the rentability and the quality of the renters that you see. And then one of the most important criteria is property management. There should be a good selection of property management companies that are competitive with one another to produce good service. You don't want to be stuck in a situation where you have a bad property manager and there's only one or two other companies nearby and their service isn't much better. Okay. So this is our team here. It's a breakdown of several of our offices. Top left with that massive sign, that's going to be our kind of like New Braunfels, Austin team. And top right, you'll see our San Antonio team. Some of our Dallas and Houston team members flew in for the photo. Bottom left, you're going to find our Florida team. Center is our Newport team. A lot of like our private lending team you'll find in the Newport office. Same with like our accounting and some of like our general staff positions. And then bottom right, you'll find the Tennessee office and the Tennessee team. Okay. So I'm excited to, get into this topic and see what Erin has to say for us. But before, I just want to give you an example of a 1031 exchange. So on the left side of the screen here, you'll see a single family home that was purchased in cash by one of our investors. They bought this property in 2018 for about $184,000. And when they sold it in 2024, they were at 260,000. Well, instead of paying the capital gains tax, they decided to 1031 exchange that property into a property that maybe is a higher producing cash flow property, or just they own more in real estate and it's newer, it's not as much maintenance, and they didn't have to pay taxes on the capital gains. So the rent they were receiving before was about $1,700 a month. And for the exact same price, they didn't add any other dollars into the purchase. They went and they got a property that was a duplex that produced basically double the amount of rent, and now they have an asset that's appreciating at $545,000 versus a $260,000 asset with appreciation. So if you look at the appreciation, it's almost double the amount of appreciation and double the amount of rents received every single month for the same price. And with that being said, I want to hand it over to our incredible exchange coordinator here, Erin. You want to kind of just dive into it?
Hello. No, that's all perfect, and that's why I want to talk to you. I assume that most of you, if not all of you, are investors, and a 1031 exchange is a section of the code that benefits real estate investors, unlike any other part of the code. And I don't think any other industry really has this type of a benefit written into it. And it basically allows you to have an indefinite interest-free loan from the government, because you get to, instead of paying your tax at the time, you get to keep that equity that you made, in your hard-earned equity that you made on these rental properties, and use them to put them into new properties, to leverage them to multiple properties. So you're going to be able to get a better location, diversify them, or even increase your holdings. So that's what we're going to talk about. The first thing we're going to talk about is, oh my gosh, what taxes you have to pay when April 15th comes around, like it did a couple of days ago. We all love investment real estate because it gives us write-offs, it gives us a future, and it gives us appreciation and those rent checks. But when we do sell, we're looking at least 4 levels of taxes. The first one is depreciation, where even though it's kind of a double-edged sword, where we've been getting a benefit for all the years that we've owned property, we're writing off that depreciation and often taking a loss against our income, and that gives us a great write-off. But when you sell it, the IRS says, listen, all those years of you taking that depreciation, we want you to add it all up, and we're going to tax you at 25%. So it can be a pretty big hit, even bigger than the capital gain itself. The capital gain itself is at 15%, and for high earners, it's 20%. So most of us are in that 15%, but when you sell a property with the last several years of appreciation, it often throws us into that 200% category, that 20%. And then we have a net investment income tax, and that was put into play. We call it the Obamacare tax because that was put into play to help fund that. And it hasn't been yet repealed, so we still have that 3.8 on really any of our investment income, our rentals, and our proceeds from sales of investment properties. And then, of course, we have state taxes, which go anywhere from Texas to, to zero, to some of the mid ranges like Colorado, we're in the lower range, to New York and California, we're up in the higher range. So those 4 levels are what you are faced with when you are selling an investment property. The beauty is that all 4 of those levels are deferred when we do a 1031 exchange. And they're not taken away, they're not excluded, they're just passed into the next property and the next one and the next one and the next one. And it's this strategy where as long as you continue to reinvest into real estate and like-kind properties, that gain keeps getting deferred. And then hopefully when you keep doing it until you pass it to your heirs, and the heirs get a step up in basis. So most of our clients will never pay those taxes. They're just going to continue to defer them. This is the code that was put in this is the part of the section that was put into the code well over 100 years ago. So it has been in our code for a very long time. And it very simply just says that we're not going to recognize gain or loss on property as long as we exchange it for real property, and as long as it's property that we use in a trade or business, like our ranch or office or factory or our farm, or for investment, like our rental portfolios, if it's exchanged for real property of like kind. So similar properties, investment properties that are held for productive use in trade or business or for investments. So it kind of highlights the important part is it's got to be exchange of real property. It can't be exchanged for property for a promise to build something or cash in my pocket or a boat or something else. It's exchange of real property. And it's got to be like kind, but it doesn't have to look the same. It doesn't have to be in the same state. It doesn't have to be, if I sell a condo, I can buy a fourplex. If I sell a fourplex, I can buy an apartment building. If I sell an apartment building, I can buy a bunch of single families. Or I can buy land or several other things. So I have a lot of options. I'm just looking for it to be an investment property. And it doesn't tell us how we determine what's held for investment, so we'll touch on that a little bit. So the reasons that this is a great thing for real estate investors is that, as I said, it defers all 4 of those levels. If you're out of state seller, it defers that, it waives that withholding tax that most of the states require. If you're an out of the country seller, it waives the federal, the FERPTA. As long as you file the right forms, it can waive those as well. So that's 6 levels that it really does help. It makes wealth accumulation faster. If you start exchanging young and early, and every time you do an exchange, and every time you sell a property, you exchange into another and another and another, because you can do it indefinitely, then you could see how you could, by being able to preserve that equity and leverage that amount over and over and over, your portfolio is going to grow so much faster than if you sold a property, paid the taxes, bought a property, sold a property, paid the taxes, and bought a property. So it's a really outstanding to see how you can grow that portfolio. It's beautiful. So wealth accumulation, probably the number one reason that our clients do this. The second one is diversification. Because if you want to move from your California property, if you're there, and then some of the things that Cameron shows you, go into Texas, maybe taking the Texas and moving into Nashville, and you can move anywhere across the country. So you can, if you're tired of one area, or if there's an area that's underperforming and you want to put it into a better performing asset, you can do that anywhere geographically across the country. Now, you can't take your property and go to buy that great little condo on the beach in Cancun, but you can go anywhere in the United States. You can go in and out of the U.S. Virgin Islands, but we want to keep them home. So if you move to another state, move your real estate with you. If you've got kids going to school in Massachusetts, buy them a property to live in Massachusetts. So the options are endless. But we can also diversify by asset class. So we can take a piece of land and we can now buy a rental property, because maybe the land is appreciating, but it's not showing us any income. It's not bringing us a check every month. So we can take that lot of land or that ranch or that farm, and we can exchange it into a fourplex or a duplex or apartment building or something that's going to make us some income and appreciate too. So we can go asset class, we can go unimproved property to improved property, residential to commercial, industrial to manufacturing to retail, back to land, back to commercial, back to residential. So pretty much all across the board, as long as it's investment property, we can move our properties into and out of it through exchanges. The two things you can't do, or there's like three things, and I think I'll touch on them later, but one of them is your primary home. That is not going to qualify. A property that you just use for friends and family, that's a second home. That doesn't qualify as like kind. And a property that you are just going to fix up and flip, that's property held for sale, and that's not going to qualify. But pretty much everything else is. Long-term ownership, if you want to start planning for your future, your kids' future, and their kids' future, most of my clients are doing this to build a life for them, money to live on and to send the kids to college, and then generational wealth, things that are going to last generations. So estate planning means that if grandpa had bought a property back 40 years ago and it's now worth $1 million and he paid $100,000 for it, the day before he passes, he'd have $900,000 worth of gain that he'd owe taxes on. If he's going to leave it to his heirs, the day he passes there, that value gets stepped up to the fair market value. And so the heirs receive that property at $1 million rate, which means they could sell that property for $1,000,001 and have $1 gain. So it alleviates all of those gains. So most of my clients are buying, exchanging, buying something else, exchanging, buying something else, exchanging. And they're doing that as their way to build wealth, and then leaving all the properties to their heirs at that step up in basis. So it's an amazing strategy for a lifetime and for generations. Some of the cons of it is that there are some strict rules. The time restrictions aren't fun. The replacement property, you're always going to be, every time you do the gain, it is going into the next property. So your basis in your new property, it would normally be what you paid for it, but in an exchange, your basis is lowered by the gain that you just put into it. So if you exchange, your basis is very low, which means your gain over time has increased quite a bit. The lack of liquidity, you don't get to take that money from a closing home and go on a crazy shopping spree or go travel or put in the bank. You need to buy property. You need to buy like-kind property to make this work. Cannot recognize losses. That's not really a con. I don't know why I put that in there. I mean, you don't want to recognize losses because you want to keep those losses and recognize them later when you've got other gains. Possible risks of higher tax rates, we don't see that happening anytime soon. And it is just a deferment. It's a deferral that is, we're not seeing it now, but as soon as that money goes in your pocket, you can bet that the IRS is going to see those funds. So again, it's kicking the can down the road. It's deferring it. It's moving it. It's not getting rid of it, but it does a couple of things you can do. I mean, we've got people who buy you can move into the final property and live there forever. You can pass it to your heirs. So some of the basic requirements that I'll touch on a little bit more as we go through is that the IRS says you can't touch the money. And you all have heard that story, but what does that mean in days when we don't touch money anymore? That means that you as the seller and the taxpayer can't sign on the bottom line of that settlement statement without a qualified intermediary in the middle, taking away basically those rights so that you don't have constructive receipt of those funds. If you sign on that settlement statement and walk away from closing, whether you've touched that money or looked at it or smelled it or saw the check or anything, doesn't matter. The fact that you signed and gave away rights and responsibilities of ownership meant that you had right to those funds, and to the IRS, that's a done deal. So what we do as a qualified intermediary is you're going to set up the exchange prior to closing. You're going to contact us as a QI. We're going to, your realtor's going to put a little clause in the contract just saying that the seller intends to do a 1031 and retains the right to assign it. And we're just going to get there in the middle and magically assign onto that contract so that we have the right to hold those funds. And we have the right to hold those funds for 45 days while you go look for replacement properties. And I'll touch more on that later. So the first rule is you want to set up the exchange before you close. You cannot set up an exchange after you've closed on a property. So we typically set it up when you go under contract, but we like to be available to answer questions when you start thinking about what you're selling and when you're when you're listing the property. That's when questions might pop up. That's when I like to get involved just to make sure that I answer all the questions. But we don't do paperwork until contract, and nothing that happens until closing. But at closing, we're going to hold those funds. So the second rule is we've got to keep that tax-paying entity consistent so that the entity that actually files the taxes is the one that actually buys the property on the other side. And that sounds simple, except when you're dealing with LLCs, that might be Erin LLC, and Erin LLC might be 4 people, which means that my LLC is a tax-paying entity and it needs to go out and buy the new property. Or it could just be Erin LLC and it's just me as a single member, and I can buy that new property in my name or that LLC, or I can create a new single member LLC. So my job as the QI is to make sure I understand who the tax-paying entity is, who's filing, even if we've got to get your accountants involved. And I have to make sure that that stays consistent on the contract to sell and on the contracts to buy, so that we make sure that we're sheltering the tax for the right entity. So then we've got the third thing is it's got to be like kind. It's got to be held for a trade or business or for investment. It can't be those 3 things I mentioned. Held for sale, something you're going to fix and flip, something you just held for a short time, something you just finished building, something you just finished renovating. So fix and flippers can't, builders, anyone who's holding something short term or for sale. Something that you're going to move into immediately. You can move into something down the road. The IRS says, sure, rent a property for 2 years, then you can move into it, no problem. But until then, they want you to rent it if you can. They want you to intend to. So that was what makes it like kind, how you treat that property. The tax deferral requirements, we're going to talk about that in a minute, about how much you have to replace. And basically, it's what you sold that property for minus my fee and, you know, Cameron's fee and any recording costs. So you're basically replacing the value of the property you sold with property, one or more, with equal to or greater value. So we'll talk a little bit about that. Timeline, I'll go through this at least one more time just to remind you, but you've got 45 calendar days starting the day you close is day 0. You've got a full 180 days from the first closing, because you can sell lots of properties and buy one, or sell one and buy many. So from the day the first property closes to the day the last one is always 180 days. They both start at the close of it. It can be longer or shorter. There's a couple of rules, and we'll go into those in a minute. And the identification rules, most people are going to do 3 property rules, but we have the 200% and the 95%. So again, I'm going to go into these just a little bit deeper. Okay, so constructive receipt, I think we covered this. You've got to set the exchange up before closing. Again, the tax-paying entity, we want to make sure that if the wife sells the property, she buys it. If the LLC sells the property, the LLC acquires it. It's part of my job to make sure I discern who the tax-paying owner is. Okay, now like-kind property, as I said, we can go all over the board. Land to single family to apartment, commercial buildings, back to land, industrial properties, all those different things qualify for like-kind property as long as we treat them as such. So it's not whether it's improved, or it's not where it is or what it looks like, it's how we treat it on our taxes. So here you can see all the different things that we can do, switching in and out. And if you have any questions, can I buy this, can I buy that, just give me a holler. You know, can you buy a boat that's docked? No, but can you buy a boat that's part of the real estate? Probably. So anyway, there's a lot of different like-kind properties and I'm always happy to answer. Again, these are what you can't. I bring up partnership interest because a lot of times you guys are buying your investment in partnerships. And when you're doing that, you may say, you know, I own this building with 3 of my friends, but you don't own the building in exchange terms, because you own a personal property right. You have a right to that building because you own a personal property right in a partnership. The partnership owns that. Let me see if I talk more about that. I don't. So I'm going to go through it here. So partnership interest says that if you call me and say, Erin, I want to take my partnership share that I own 25% of and do an exchange on it, I'm going to say you can't. The partnership can do the exchange, but you just own partnership interest. What you'd have to do is talk to your partners, and you would have to do what we call a swap and drop, where you're going to divest or change the vesting, or talk to your accountant or your tax advisor, and now that partnership is going to break up into individual tenants in common. So that gets a little bit trickier. That's when you definitely would want to bring me in for any questions you have. But you can do exchanges of your partnership interest, but you're going to have to change the vesting first. And you want to make sure you leave enough time for that. So if you're working with partners or trusts and you have questions, that's a perfect time to give me a holler. So the intent has to be to hold for investment. Every now and then, like during COVID or something happens and you don't get to hold it very long, but you need to be able to show the IRS that you intended to hold it for investment. So I want to talk to you about some different things that you can exchange that you may not have thought of, and may provide some opportunities for you to buy, you know, one of those great properties that Cameron showed you in Texas or Tennessee or somewhere that you may not think of. If you have, say, a duplex or a lock-off or studio or carriage house, or even if any of you have clients with ranches or ADUs, those investment components, even though they're tied to a resident, can often be carved off on paper and be exchanged. So when you have a primary home, you get to use your primary home exclusion of 250 or 500. But if you have a lock-off or a duplex or another part of it that you are renting out legitimately, it shows up on your taxes, that portion could be used to buy something else, to reinvest into a small condo, or go in with somebody on a property, or buy another duplex or fourplex. So you actually have the ability to use that very favorable exclusion on capital gains and utilize that deferral on capital gains. So think about some of what you might have that you might be able to use, and maybe you've got maybe you've got conservation easement or water rights, or some of those things that are with your property. Those can be exchanged for more property, for a single family residence. So there's a lot of opportunities. So again, call me if you have questions as to what qualifies, but I want to get into the exchange equation. It can be kind of confusing. And the exchange equation says that, very simply, the IRS isn't looking about what you paid for the property, what your gain is, what your mortgage is. Essentially, what they're looking for you to do is take the value of the property you're selling, the sales price that you're getting for it, subtract out your cost of sales. I'm going to go to this slide, I think it better. Select out your cost of sales, and that's going to be your minimum. Or the other way to look at it is to take all of your net equity, all the cash, that net equity line, all of that needs to go into the next property. And that debt amount, that $300,000, even though you gave it back to the bank, the IRS wants you to replace it in another property. So if I'm selling a property for $900 and I have $60,000 of commissions, title fees, exchange fees, my minimum is $840. That's how much I want to go replace to have no taxes, to have full tax deferral on that. If I go a little bit under, I might have some exposure to taxes. If I go over, I'm fine, as long as I've taken all of my cash into that property and replaced that debt amount. So boot is what we call when I've got extra amount, when I didn't replace everything. And in this situation, you can see that we took all of our cash, our debt, and replaced it. And we took all of our cash into the next property. But sometimes you're going to find instances where you want to buy less than. Maybe you just want to downsize, and the property you want is only $700. Well, you can still do an exchange into that, even though it's not as high as what you're selling for. But you may have what we call boot, and that boot again is exposure. So if I don't reinvest all my net proceeds, let's say I put $100,000 in my pocket, and I acquire and I get a lesser loan on that property, I've got $40,000 a mortgage boot and $100,000 of what we call cash boot. I've got exposure of taxes on $140,000. Well, that may sound like a lot, and that may be something you don't want. So you could take that $140,000 and buy something else. Put it towards another condo, leverage it up, do something else with it, because you can, as I say, you can sell multiple properties and you can buy multiple properties. Or at that point, then I need to know what your gain is on that property. And if you paid $100,000 for that property and you're selling for $900, that's an $800,000 gain. Then $140,000 that you have exposed to is nothing. That's great. I mean, you're deferring so much, and yet you still get $100,000 in your pocket and less mortgage. But if you paid $100,000 or $800,000 for that, and your gain is only $100,000, then that exposure is going to tell you that an exchange is not going to help you. So it's my job just to make sure that when I talk to you, that exchange benefits you, and that we are going to be doing the best thing for you. The last situation I want to show you is real quick, is a lot of times you hear that you just want to buy more expensive property, and that's somewhat true, but you still have to follow that first rule, because even though I sell for $900,000 and I buy for $1 million, if I don't first use all of my cash into that property, I still have exposure. So I always want to first use my cash, then get a loan or bring in cash for that remaining amount. Once I finish my exchange, I can go to my bank and pull it all back out again and use it for something else if I wanted to. These are the costs that we can pull out of that you don't have to pay capital gains on, and that you don't have to reinvest. So real estate commission, so what you pay to Marshall Reddick, that comes off of your taxes you have to pay off of your gain. Title insurance, those closing fees, any legal fees or notary fees, recording fees, and if you work with me, my exchange fee. So those things come off, and it's kind of a nice little benefit. The new basis, I just want to bring this up just to show you what happens to that gain. And as we talked about earlier, the basis, the capital gain that you saved on one property that you deferred into the next one actually goes and lowers the basis. So if I made 800,000 gain, I deferred it into a $2.3 million property, but my basis dropped to 1.5, meaning if I sold that property the very next day for 2.3, it looks like I didn't make any gain at all, but I did. I made 800 gain. So that's why when we're doing exchanges, we want to keep reinvesting those funds. We want to keep doing exchanges. So just real quick, there's a couple different formats. You can do a swap. Every now and then you're going to buy somebody else's property and they're going to buy yours. And that's a two-party swap, but it doesn't happen very often. For the most part, when you sell your property, you're going to use a qualified intermediary in the middle. You have to use a qualified intermediary. We're a necessary evil to make this all work. In order to do an exchange, you've got to have us in the middle to keep you, the investor, out of the reach of those funds. Multiple property exchange, I put that in there just to say I can sell many properties, I can buy many properties. But when I've had them all in one exchange, they start when the first property closes. Parking arrangements are something different. They're kind of a workaround. If I need to buy a property first before I sell my property, I can do a reverse exchange. It's not quite as easy as it sounds, because if I bought the property first and then tried to exchange into it, I can exchange into something I already own. So that's when I have to hire the QI. It's more complex, it's a bit more costly, but the QI actually takes your funds and parks title on that. An improvement exchange is similar. They're more complex, more expensive, but it allows you to buy something maybe not fully improved or not quite built, and it's not quite up to the value you need it to be. So it allows you 180 days to get it to that value. So call me on any of those if that sounds like something you may be interested in. Again, we're just doing a quick preview, so those are a little deeper topics that I just wanted to touch on, but we'll get into. This is the picture of what a delayed exchange looks like. The deed itself always goes from the taxpayer to the buyer, or from the seller back to the taxpayer. We as the QI in a delayed exchange, a regular, normal garden variety, don't get involved. But what we do is, because we sign on to each contract, we have the ability to hold those funds. We're going to set it up in a nice, sweet, safe account, and we're going to hold it. And then as soon as the taxpayer says, this is what I want to buy, we're going to assign onto those purchase contracts as if we were the buyer, and we're going to use those funds and buy those contracts, to buy those properties, and the deed is going to go back to the taxpayer. So we're just holding that money, getting in the middle, and facilitating the exchange. That all has to take place in 180 days. The identification period, the crux of it, the part where Cameron's most really helpful, is helping you find properties to buy in that short time. That 45 days from closing isn't very long. And you can be looking at properties ahead of time. You can throw contracts on properties ahead of time, but we don't want them to close until you've closed on your relinquished property, the one you're selling. So relinquished property, then your replacement property. Okay. So that's how the exchange looks. I say that those times are set in stone, and they pretty much are. But we have a lot. The IRS says you have 180 days most of the time. If you closed late last year and you just filed your taxes, you might have shut off your time, because it could be shorter by filing or paying your taxes before you've completed your exchange if you bought last year. So that's one provision. The only thing that's going to give you more time, the only thing, is a federally declared disaster on the property that you are buying. the property that you intend that you are selling, or your own property. So all of us have been affected by those. If you are, you work with your CPA and you can get an extension of 120 days, but it's very distinct as to which one's qualified. So if you think a property that you're dealing with may qualify for an extension, talk to your accountant, or you can give us a call. The identification rules, this is what you've got to provide to the qualified intermediary within 45 days, by midnight of the 45th day. You're allowed to identify 3 properties of any value. So if I sell for 800, I can identify one for $1 million, or one for $2 million, or one for 900. It doesn't matter, but I only get 3. I don't have to identify 3, but I get to. In case one falls out, I've got 2 backups. The 200% rule says if I'm going to take my property and I'm going to spread it out to maybe go to Tennessee and buy 3 different properties or 4 different properties, I might have to identify 5 or 6 properties to get what I want, to have some backups. So I can identify as many properties as I need to, but I'm capped at the value of those properties. The first one I'm capped at the number, the no value. The second one I'm capped at the value and not the number. I can identify as many properties as I need to, but I can't go over twice what I sold my property for if I added them all up. And the third rule we rarely see, and that says if I blow rule and blow rule number 1 and blow rule number 2, I have to make sure I buy 95% of everything on my list, or I fail the exchange. So those are our identification rules. This is what I have to do it. These came in 1990s, so they're a little outdated, but I've got to have those identifications written up in writing. I have to describe the properties I want, the addresses. I've got to fax it, email it, get it to the qualified intermediary. I've got to do it by midnight. And I can't get it to anybody but qualified intermediary or a title company. And anybody, even Cameron as a broker, is going to be disqualified. So get it back to the qualified intermediary. Lastly, you're going to ask how the IRS knows what I bought. Did I buy from a relative? Did I buy like-kind properties? Did I drop out of an exchange? Because this is what you're going to tell them. You're going to file this form, or your CPA will file this, and it just pretty much explains what happened during the exchange, and that's how it's reported. We're one of the top companies in the country. We're one of the top leading national qualified intermediaries. We've been working, gratefully and honored to be working with Marshall Reddick for 20 some years. And we are kind of your go-to people. If you have any questions, always happy to answer questions, always available to be here for you. And now I'm going to pass it back to Mr. Cameron, and he's going to show you just a few exciting properties.
Yeah, Erin, that was incredible. Thank you so much. A lot of information, a lot of details there. I'm very grateful for everything you said. Anybody, if you have questions, please feel free to type it in the chat. So, just if you have questions, we can go over those later at the end of the presentation or on a follow-up call. But great information. Thank you so much, Erin. And I'm excited to show you guys a couple property picks. I know we saw an example a little earlier, but now we're gonna go over some more newer properties that are available right now. So a lot of properties that we have listed on our website, we want to put those out there because we see them as good investment opportunities for you as the investor. So if you go to marshreddick.com, click on properties, you can filter through a large inventory of properties based on the specifications of what you're looking for. This one, for instance, is a duplex, and this one's going to have obviously 2 sides on it, but there's an interesting thing that you'll see in the middle there under gross rent. You'll see where the mortgage payment usually might be closer to 7%. It says 3.75. So what we've found is developers are offering forward commitments, which is essentially a rate buy down larger than the standard everyday rate buy downs. And the cool thing is that when you look at the interest rates, it makes a big difference on your cash flow. So getting a 3.75 interest rate versus a 7% interest rate is night and day difference. And so that's why we like to feature some of these properties when we're taking a look at our webinars, because they're great options if you're 1031 exchanging. What we find too is when you're exchanging a property, you had to have owned it for a good amount of time in order for that property to appreciate and have enough value for you to exchange. And oftentimes you're probably coming from a property that maybe had a lot of maintenance or a lot of work to it. That's kind of like a headache. And so for the same dollars that you're putting in, you can get a property that's brand new, a property that doesn't have headache, doesn't have as much maintenance. And that's honestly what we're seeing a majority of our investors transitioning into. And so that's why we put this one out here. So for this property, it's at a 475 purchase price. And this pro forma was run with 30% down. That's pretty standard. Obviously, if your 1031 is greater than whatever the down payment is, we can run those numbers for whatever down payment you would like. The gross rents for the 2 units is $29.90, and you'll see the fixed expenses come out to about $26.86 a month. So your cash flow is $300 a month. Now, we always give you the worst case scenario equation too. That's where you'll see the variables. They're not guaranteed expenses, but they're something that you can maybe save for or potentially account for. We call them like save it for a rainy day. So for instance, if there is a maintenance repair, maybe you want to factor that into your cash flow equation. So we put 5%. The properties are very new. They come with warranties. So you probably might not see 5%, but let's just say in 5-6 years from now, you got to start replacing things, or maybe things are breaking and you need to fix them. Maybe they're not under warranty anymore. So just factor for that. And then as time goes on, when properties become 10, 15, 20 years old, you can increase the maintenance. And then the vacancy is just the days that the property is not rented. So if it takes 30 days to get a tenant in place, that's about 7% vacancy. It's just 1 month's vacancy. So it's something you can factor in there. But overall, when you look at holding the property for 15 years, you're going to take a look at the appreciation you'll receive as well as the cash flow you receive. And we're seeing this one at about 19%, given the current metrics, which is an incredible opportunity at this moment. Okay. So this next one we want to show you, this is more of a heavy cash flow play. This is a Puente Gorda duplex in Florida. And the reason why these are great is they're brand new as well, but they're built to standards that are far beyond what you can imagine, which is great. So we don't see any issues, and we don't have as difficult time with insurance costs there. Now, this developer particular, on top of the forward commitment, this forward commitment's at 4.75. They're offering a full year of property management for free. And then these ones are actually pre-leased. So you don't have to wonder if it's going to lease, what the amount is going to lease for. We know the gross rents are $4,100 a month. So that's what the gross rents are. And the purchase price is $600. This is also at a 30% down payment, and your cash flows come out to about $530 a month. And that's pretty accurate because we already know what the rents are. So there's no question there on, are the rents going to be a little lower, or are they going to be at that price? We know what the price for the rents are. Okay. And this last one here is a single family option. So Clarksville, Tennessee is a suburb of Nashville. I'm sure all of you have heard of Nashville. Nashville's awesome. It's a booming city, although the price points there are a little high. And so like we mentioned earlier, we like to see those suburbs where it's not too far from the center of the big hubs, but it's still more affordable in a family-friendly area. And that's where we find Clarksville at. Now, these are, I would say, high 3s to mid 3 price point single families. And you'll see here, we have 30% down again. Your cash flow is just under $300 a month, and your annual ROI at a 15-year hold comes closer to about 14%. Clarksville's a cool market. Tennessee, there's no state income tax. Your taxes are not reassessed every year. So it's overall a very stable, steady market. A lot of first-time investors choose Tennessee because of those metrics. And once again, all of these markets are very landlord friendly. And I'd be happy to answer questions on these or go over other properties that you see on our website or off our website in a follow-up consultation. So anything that we talk about here is going to be based on like property classes, and that determines the appreciation, the type of tenants, whether you're receiving cash flow, whether you're receiving more appreciation, and all of that you can download here on marshallreddick.com/ebook. This is essentially like the Marshall Reddick Real Estate Bible. So if you get a chance, this is a great resource. We highly encourage you to take a look at it. Okay. And this webinar, as well as many, many others, can be found on our website on marshallreddick.com/learn. And there's going to be calculators on our website. There's going to be articles, data packets, just about anything you can think of real estate related. It's all free, and it's right here on our website, just marshallreddick.com/learn. So something that's cool is take a look at what other people are saying. Don't just take my word for it. Don't just take Erin's word for it. Although, you know, Erin's word is very trusted. We've worked with her for many, many years. Feel free to look up Marshall Reddick online. See what people are saying about us. Reviews tell a lot about the story of what a company's doing. And I highly recommend you take a look at our reviews. These are some of them here. Newport on the left, and then San Antonio, then Clarksville, then Cape Coral. And then if you guys get a chance, follow us on social media. Feel free to write us a review. Let us know how the presentation was, what your thoughts were. We would love to get feedback from you in general. That's very important. A lot of these topics are actually recommendations from you guys. So if there's a topic that you haven't seen that you want to see, just let us know. We'd love to do that topic. We'd love to go over it with you. So next steps is really a consultation call. This is when we'll sit down, we'll go over your goals, figure out why you want to invest, or why do you want to do a 1031 exchange? Does it make sense? How does it work? We'll connect with Erin, we'll meet together. Maybe we look at time frames. Do you want to move quickly? Do you want to take your time? What is your goal for a replacement property? What is your criteria? We're going to take a look at what markets make sense. Some markets might not make sense for the price point, while others might make sense just because of the dynamics you're looking for in a market. And then that's going to be introducing you to all the key players. Think of us as like the quarterback, and then we'll loop in people as needed. So title, escrow, inspectors, just about anything you need, we have those resources. And then you want to kind of finish that off here. So this is my contact information. Now, I did see a comment, someone asking about Erin's contact info, if we can bring that slide back up. So Erin, do you want to go back to your slide real quick?
Yeah, maybe.
Or maybe if you want to just, yeah, maybe you can end the slideshow, and then you can probably end the slideshow real quick, and then we'll scroll back up to your slide there.
And I think it is also on your website.
Yes, that's correct. So on our website, you'll find Erin's contact info under preferred vendors. Perfect. If you want to just hit slideshow from current slide, then we'll put that up for you there. So here's Erin's contact info. If you guys want to reach out directly to her, this is her cell, this is her email. We'd love to do a consultation with you. Erin is a wealth of knowledge, as you guys just learned, but we really look forward to meeting with you guys on a follow-up call. Okay, I saw another question here. For depreciation purposes, is the purchase price used or the lower basis amount? Maybe you could help us with that one, Erin.
Boy, that's a good CPA question, because it's actually would be the lower basis amount. Well, it's a lower basis plus if you added any more into it. It depends. Most of the time, if you're buying up and you're adding more money to it, your original basis basically stays and flows into the next property. And then you take your original basis, add in any new cash that you put into it, and that's now your new starting basis. And that's what you use for depreciation. So if you're buying up, you're buying more expensive, you're adding more depreciation, especially if your property was fully depreciated. But that's a good CPA question that I'm going to pass on, because I can get in the weeds in depreciation.
Yeah, absolutely. And we'd be happy to refer you to our recommended CPA. We work alongside Murphy. But if you reach out to me in a follow-up, I'll go ahead and send you their email and their phone number so you can contact them directly if you don't have a preferred CPA. Or if you do have a preferred CPA, this is a great question to ask them. They're going to have the best answers on that. Awesome. Any final closing notes, Erin, you want to leave us with?
Just if you're an investor, this is a great tool that you can use. We do a lot with Marshall Reddick, and honestly, of all the properties I've seen, I haven't seen any that have those performances. I haven't seen many that have the performances that you just illustrated. So I mean, that's very exciting. Those rates and those performances are quite outstanding.
Yeah, absolutely. And we've been around since 79. So it's cool to see all of the pro formas and numbers actually hit when our owners have owned these properties for 10 to 15 years. And they're pretty dead on. But obviously, the long-term hold is where you'll really experience the return with that appreciation. Absolutely. Well, thank you guys for joining us tonight. Have a wonderful night. Have a wonderful Easter for everyone celebrating Easter. And we look forward to seeing you on the next one. Once again, the webinar will be sent in a follow-up the next 24 hours. You'll be able to see it, watch it back, and get the slide deck. Thank you guys so much.
Thank you, Cameron.
Thanks, Erin. Take care, guys.